In the next 11 minutes, I'm going to teach you every single ICT concept that you need in order to become a profitable trader. And I wasted a lot of time trading other strategies. These ICT concepts that I'm about to show you are going to be the fastest way to become profitable. And in this video, I'm going to teach you liquidity, market structure, MMXM, AMD, and finally putting it all together to make a profitable entry model. So the most important thing in the foundation of all ICT concepts is liquidity. Price is always targeting liquidity because that's where the most stop losses are in the markets. There's two key types of liquidity: the external range of liquidity, which are swing highs and swing lows, and there's internal range of liquidities like fair value gaps and order blocks. You have to understand the market wants to do one thing, and that's to seek those liquidity because of course the stop losses are there, and that's where the big money and institutions in the market actually want to take them out. And price moves like a magnet from one liquidity pool to the next. And price always moves like a magnet from one liquidity pool to the next. Let's say, for example, price taps into this fair value gap. The next liquidity pool is going to be the swing high. That's what ERL to IRL actually means. And this is an example of ERL to IRL. We form the swing high and we form this 15-minute fair value gap right here. And price sweeps out that high and taps into this fair value gap. And what is next is this swing high right here. We form another 15-minute fair value gap right here that we create an SMT with. So we actually sweep into this area and what do? We target the swing high right here. This is another 15-minute fair value gap that we create, and price of course taps into that area and targets the swing high that's resting above here. And we continue to do that in an upwards trend. And understanding liquidity is just the first step. To actually trade using liquidity, you need to understand market structure. And pretty much all market structure is just highs and lows. But in order to actually understand it, you need to know the difference between manipulation and displacement. And so before I actually go into market structure, I want you guys to understand what a swing high or swing low actually is. And we're going to use a 3-candle formation, a 3-candle pattern in order to identify what it is. So you guys can clearly see we have this first candle right here, which is a higher low. Then we have a lower low right here. And then we have a higher high. And this constitutes what? A swing low to be formed at this low right here, where we have this being higher, and this being the lowest point. So this 3-candle pattern that looks something like this is what we're going to be understanding a swing low or a swing high. And this is an example of a swing high where we have this low candle right here, we have this highest candle right here, and then we have a lower low right here, creating this as the swing high. What happens at highs and lows tells you everything about the market, right? So we have this swing high and we have this swing low on the lower time frames, and you guys can clearly see we have a beautiful reaction off of this, but we don't have a reaction off of this. And the reason why is when we don't get any significant candle body closures below swing points, right, like these, we're not anticipating price to continue in that direction, rather have a reversal off of sweeping those points, right? So let's say we sweep this liquidity right here, and then we get a candle body closure above this area right here that confirms a market structure shift back to the upside. We can confirm that the market structure is actually bullish rather than any confirmations of, significant candle body closures to the downside, right? Once you see price wicking liquidity points like this, you guys can understand we're going to see reversals. And once you see candle body closures above those swing points, so this is another swing point right here, and we get a candle body closure, we're going to get that continuation in that direction. And now that we learn liquidity and market structure, we're going to pair them together to understand how to use market maker models in your trading. And I'm telling you guys, if you've ever caught a trade that looks perfect but you still got stopped out, this market maker model concept is going to explain exactly why that happened. So we know price goes from internal range of liquidity to external range of liquidity, but the question is, how do you actually trade this on the lower time frame? So this example on the higher time frame, we tap into this fair value gap and go straight away for that swing high. Now on the lower time frame, it tells a different story. As you guys can clearly see, we have this price action, and what you guys want to look for is 2 or more consolidations to that higher time frame fair value gap. You guys can clearly see we consolidate here before tapping into that fair value gap, then we reverse off that area. And all a consolidation is when price just goes from high to low to high to low to high to low, and we create a lower high and then a high to low to high to low, high to low, right? Before tapping into that fair value gap that we want price to reverse from towards that swing high that's been created already after that accumulation phase. And so on the lower time frame, we're tapping into these fair value gaps, and the way we actually look to enter is by confirming that price wants to reverse out of this higher time frame fair value gap. So in this case, we'd be waiting for a market structure shift right here. Let's say we get a significant candle body closure above this area. We could take our position right off of that market structure shift. We create a fair value gap here as well. There's so many opportunities to enter. Let's say you enter off a fair value gap here, or you could even enter off the market structure shift above this high. And all you do is just target that swing external high that's been created off of this here, right here. This swing high is just this accumulation phase on the lower time frame, and that's how it all connects. This swing high is what we're going to target. And that swing high on the lower time frame is just that first accumulation phase. And this is an example of a market maker model where we have the original consolidation at this low. We have a reversal area right here, and we get a beautiful opportunities to actually enter in this gap. We have this beautiful gap here. We have this gap here. We have this order block right here, and there's so many opportunities to actually enter in this market maker model targeting the original consolidation low. And a good thing to remember is a higher time frame for value gap equals to a lower time frame MMXM. So let's say price taps into an hourly for value gap, you'd be looking on the 5-minute time frame for that MMXM. And let's say price taps into a 15-minute for value gap, you'd be looking for a 1-minute market maker model. Let me ask you a question real quick. Whenever you look at your trades, do you ever wonder why some just explode and others just stall? Well, the next concept that I'm about to teach you, which is the AMD, is going to solve all those problems and make you understand why and when to actually trade. And AMD is very simple. All the principles behind it is that price moves from an accumulation to a manipulation and then a distribution, following this 3-step pattern in every single expansion. So in this example, we have this accumulation, then we manipulate, right, the fake out of the range, and then we actually distribute in the true drawn liquidity. Now, an important thing to understand is without an entry model, everything else you learn today is just theory. You need to understand a model is what brings everything together and actually makes it a well-oiled piston. And so let me ask you this. If I gave you a consistent entry setup right now, would you actually use it? And I'm going to share with you guys one entry model that I use using all 4 of the concepts I've taught you today, and let's get straight into it. And it's directly called the 10 a.m. AMD model. It utilizes all the 4 things that I've taught you guys, and I'm going to go in depth on how to actually use it. Now, the most important rule of this 10 a.m. AMD model is when we don't tap into a key level, we cannot look to trade. And our key levels are always going to be those fair value gaps and those swing highs and swing lows. And the reason it's called the 10 a.m. AMD model is because we're going to use the 10 a.m. 4-hour candle to condense all the concepts that we've learned. So what I mean is we're going to trade the 10 a.m. 4-hour candle and use all the concepts that we've learned in order to actually make it into a repeatable, consistent model. So the first step of this model is to wait for the 10 a.m. 4-hour candle to open up and see what it does. As you guys can clearly see, the 10 a.m. 4-hour candle opens up. And what are we actually looking for in order to actually take a trade? Well, the most important step is that we need a key level to be engaged before we can actually take a trade. And so in this case, we have our swing low that we want price to engage and react off of, continuing back into what? The internal range of liquidity on the higher time frame. So of course, the first thing we're going to be doing is waiting for that low to be swept. And as you guys can clearly see, we sweep out that previous 4-hour candle's low. And now our target is going to be that external range of liquidity that we marked out right here. And as you guys can clearly see, we get a sweep of this previous 4-hour candle rather than a candle body closure. We don't get consecutive candles continuing in that bearish direction. So we get this beautiful reversal candle right here, and we form what? A market structure shift right here. Off of that market structure shift that created the new high, we want price to tap into a key internal level to confirm that price is going to go higher. So in this example, we have this nice 3-minute fair value gap that I want price to internally react off of. If we're going to be bullish, we're going to respect this gap. If we're going to be bearish, we're going to inverse this gap. So this is going to be a key level of where price can react off of. And I want to see how price reacts off of this area. And we get a closure above the last series of down close candles. And you guys can clearly see we respect this 3-minute gap, and that shows us price wants to continue higher towards this drawn liquidity. Now we can look to take any entry model that we want. Me personally, I'll look to trade this order block that we form right here. So I'd keep my limit order off this order block, keep my stop loss at this low, and target this high for a nice 2R. Let's see how this 10 a.m. AMD model works with liquidity and market maker models. And you guys can clearly see this is the sell side of the model, and then we're starting the buy side of the model, trading towards this consolidation. And you guys can clearly see we tap into that area and we tap into that gap that we want price to react off of. So this is a beautiful trade, and if you guys enjoyed this video and learned all the concepts, like the video and subscribe, and I'll see you guys next in my next video.